A business combination occurs when one company gains control over another. The result is a single economic entity for reporting purposes. Rather than maintaining separate financial statements, the two entities are reported together in consolidated financial statements. The key factor that triggers consolidation is control, which doesn't always require that the acquired firm be legally dissolved. What matters is who holds the power to direct financial and operational policies. There are several reasons why companies pursue combinations. They want to grow their value and increase scale. Business combinations allow firms to boost margins, expand into new markets, and become more efficient. They also help firms achieve synergies, for example, aligning production and distribution or leveraging technology. Lastly, by combining, firms can spread out risks and gain easier access to capital. There are several forms of combinations. In an asset acquisition, the acquired company is dissolved, and its assets become part of the acquirer. In a stock acquisition, the acquired company remains intact but becomes a division. In a statutory consolidation, two firms come together to form a new legal entity. Lastly, if a parent company acquires a majority of voting stock, it creates a subsidiary that it controls, even if the subsidiary keeps operating as a separate corporation. How consolidation occurs depends on the legal structure. If the acquired company is dissolved, its account balances are absorbed into the surviving company's books. If both firms remain legally separate, their financial results are combined using worksheets when preparing reports. The key takeaway is that the legal form of the combination affects how and how often consolidation occurs. In combinations involving dissolution, actual account balances are permanently transferred at the date of the merger. If the companies stay legally separate, only the financial reporting data, not the physical accounting records, is consolidated, and this typically occurs every time reports are issued. In the first case, the dissolved company's records are closed. In the second, both companies keep their own systems. Control is a central concept in determining when consolidation is needed. It often means owning more than 50% of the voting stock. But control can also come through governance rights, contracts, or other arrangements that give one entity the power to direct another's key decisions. US GAAP focuses on who has control, not just who owns the shares. If control exists, consolidation is required regardless of how it's achieved.